Well, a warm welcome to everyone and thank you for joining us today. My name's Joel Carty from Solace Financial. We're a locally owned and locally staffed firm here in Brisbane. Today we have a special guest, Tom King from Nanuk Asset Management. Tom joined Nanuk in 2009 and is a director of the firm and the firm's chief investment officer and one of the portfolio managers with approximately 20 years of investment industry experience in equities fund management, investment banking and private equity. He's previously an investment manager at Consolidated Press Holdings, an associate director at Rothschilds and Sons, and had worked as an investment analyst with Australian equities fund manager Herschel Asset Management. Tom holds a first-class honours degree in engineering from the University of Melbourne, and he was a gold medal winning Sydney Olympian in the 470 sailing class. He is also an Order of Australia recipient. Before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Also, refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Well, thanks for joining me today, Tom. As a Sydney Olympics gold medalist and Order of Australia recipient, how have you been able to transfer your skill sets of being an athlete into a successful career as a Chief Investment Officer with Nanuk Asset Management?
Uh, Thanks, Joel. It's been a long journey to end up doing what I'm doing now from where I was nearly 25 years ago. But interestingly, a lot of the skills that were relevant to being good at sailing at an international level are, equally relevant to making investment decisions and running portfolios in markets. And that's something I sort of had a intuition might be the case back when I was racing at the Olympics. And yeah, I didn't start out down this pathway. I actually did an engineering degree and worked as an industrial consultant, and that gave me some interesting experience in industry and business, and opened my eyes to the potential for the world to be improved through things being done much more efficiently, which is, I guess, part of the Nanuk thesis. And yeah, I'd always had this sort of intuition that the game of sailing, which is played against a large field of competitors in a constantly changing and unpredictable environment where you're making risk reward decisions on an ongoing basis around what you think might happen with the wind in the future was, in many ways pretty similar to operating in investment markets where you're trying to make judgments about what might happen with asset prices in the future, where there are aspects of that are predictable over long time frames, but there are lots of short-term effects that create noise over the top.
Yeah.
And if you look at a picture of a wind chart, that looks actually remarkably similar to a share price chart. And what you're trying to do in sailing at a high level, where you're competing in one design events like I did, where everyone has the same equipment and pretty much goes the same speed, is win by positioning yourself better in relation to the next wind shift or the next wind shifts on the course. And yeah, it was interesting. I sort of always had that in mind. And as I said, I started out in engineering and industrial consulting, but after that took an opportunity to work in a funds management business, and that, I guess, validated some of my thinking around that and the parallels and some of the sort of relevance of the decision-making and risk management frameworks that we had in sailing to the markets. And also, I guess, confirm to me that, my skill set as a sailor was really being able to make good risk return judgments in a very complex, competitive, um, uh, changing environment. And yeah, that's sort of the skill set that I think you need to be good at what we do.
It's an interesting similarity between the two that you've brought together. So thank you for sharing that. As a fund manager that specializes in global equities, can you talk us through Nanuk's history and Nanuk's investment philosophy?
So the firm's philosophy is pretty simple. So we started the business 15 years ago, just after the financial crisis, looking broadly across markets and asset classes at where there might be good long-term investment opportunities at that point in time. And those sort of conversations around that gravitated towards things to do with, in a corny way, saving the world. It seemed obvious to us at that point in time that um, ongoing population and economic growth around the world uh, was incompatible with the sort of, already quite evident resource constraints and environmental issues like climate change, but also water scarcity, land degradation, air pollution, ocean pollution, and so on. And one way or another, those two things have to reconcile either through, dramatic decline in population growth or lower ambitions in terms of economic growth, particularly in the developing world, or through the economy changing in a way that the companies who provide solutions to those problems are very likely to benefit. And so we started looking at where those opportunities were and whether they were investable. And I guess the interesting takeaways there were there was actually quite a lot of opportunities on a global basis that were readily accessible through global equities. There was very little in Australia where you could get exposure to companies providing sort of technology or solutions to resource efficiency and environmental problems. And where there were companies in Australia, they were, generally speaking, small cap businesses with big challenges to compete in international markets. And so we looked at the global equity opportunity set, and yeah, it was interesting that at that point in time there were very few asset management firms dedicated to understanding the dynamic that we were looking at and investing for clients to take advantage of that. And so we saw an opportunity to start a business that would develop sort of expertise in what was going on globally in relation to sustainability and the investment implications of that, and then provide investment products that allowed clients to benefit from that knowledge.
Okay.
And yeah, initially we had a much more concentrated fund that was actually a long short hedge fund that was investing in primarily things to do with clean energy and energy efficiency, where there was a larger opportunity set 15 years ago. And over time, we've expanded our coverage out into the broader range of sectors and industries that we look at now. And about a decade ago, we got to a point where we felt we could run a more conventional long only global equity fund that had a sufficient level of diversification and risk control to be interesting and useful to clients like yourselves.
Okay. So when we look at the investment process, what is the investment process that the Nook uses, and how do you assess risk when you make those investment decisions?
I guess in really simple terms, our investment process is focused on identifying companies that will outperform, will deliver alpha because their prospective future value is greater than what's reflected in the share price today. And so we're looking for companies that have economic value or are able, particularly to grow economic value over time, where the valuation today is attractive, relative to the share price. And we do that by sort of screening our opportunity set, which is well over 1,000 stocks globally now, for good quality companies, so companies that are profitable and generating good returns on tangible invested capital, so they're able to increase their value as they grow, that are operating in industries where we feel like the medium-term dynamics are likely to be favourable for those businesses, and then trying to assess the valuation of those businesses to work out whether owning the stocks is likely to generate attractive investment returns. And we have a set of screens that are valuation based, so you're looking across 1,000 stocks on a weekly basis to try and identify things where maybe share prices have fallen excessively in relation to the way the fundamentals of the business are evolving and prospectively cheap, or looking for areas where the fundamentals of businesses or industries are improving. So cyclical industries recovering, companies with structural improvement in profitability, industries where growth rates are accelerating because of changing technology or government policy, things like that, and then trying to find companies that are going to benefit from those trends and assess their value in the context of our views about how those industries or companies might evolve.
Okay.
And we have a team of 6 of us, reasonably experienced global equity portfolio managers, all focused on that task of finding potentially attractive investments and researching those with a view to including them in the portfolio.
Great. And when you look at the opportunities and the risks in the global landscape at the moment, is there anything that comes to mind that people should be aware of?
Look, at any point in time, there's always factors that have driven recent returns in the market. There are always dislocations in the performance of different sectors or different regions, different types of stocks. In the last 12 months, it's been a period where the performance of large cap technology stocks with exposure to AI have performed extremely well relative to large parts of the rest of the market. And we have some exposure in the fund to some of those companies, and particularly to some of the sort of lesser known beneficiaries of what's going on with AI. But at this point, it's becoming sort of increasingly difficult to justify valuations for stocks in that sort of area because of how much their share prices have gone up. And we're seeing opportunities in other parts of the investment universe that we cover, where share price performance over the last couple of years has been mediocre, and industries are potentially going to see improvements going forward. And so if you look at some of the some of the areas within renewable energy or clean energy technology, if you look at med tech companies, things like diagnostic and analytical equipment serving the bioscience and life sciences industries, and then interestingly, despite the extraordinary performance of global equities and the US equity market in particular, there's still some pretty interesting opportunities amongst US industrial stocks where I guess market headlines belie the fact that the US industrial economy is still relatively weak and recovering from a downturn post-COVID, and we expect to see a range of businesses there benefit over the next couple of years as high inventory levels start to come down and companies resume sales at more normal levels, and consequently see growth and profitability improve.
Okay. And what would you see Nanuk's greatest strengths as a fund manager?
A couple of things. I mean, we have been around for a while, focused on what we do, and we focus exclusively on a fairly narrow set of industries and technologies related to sustainability and resource efficiency. And having done it for that long, I think we have some reasonable insights into the way that those industries tend to behave, and the way that things like government policy and step changes in technology tend to play out over time, and that's helpful to us. We have a fairly conventional investment approach with a sort of strong focus on fundamentals and valuation, which has served us well over time. In some of the areas we focus on, there's a propensity for stocks to become very expensive as investors seek exposure to thematics where there are limited numbers of stocks that are available for people to invest in. And the outcomes of that and stocks becoming expensive are almost always that investment returns end up being very mediocre. And so we have a focus on valuation that has helped us avoid the pitfalls that many of our peers, and particularly the sort of more passive ETFs, have experienced over time. And then we have a pretty experienced and smart group of investment managers working together in a way that gives us pretty good coverage of the opportunity set and allows us to be dynamic in the way that we structure the portfolio and manage it through different periods.
Okay. Now, can you talk us through a time when you've turned a period of poor returns into an investment opportunity and turned the performance around?
Sure. I mean, there's been, as is the case with every fund, periods where the fund hasn't performed as well as we'd like. And in each case, we've seen reasonable recoveries from those periods of underperformance. The most recent one of those was through the middle of last year. So in the third quarter of last year, the fund underperformed in part due to exposures to technology-related stocks, which had a period of relatively poor performance. There were concerns about overcapacity in the semiconductor industry, and that having implications not just for the semiconductor manufacturers, but for capital equipment providers and suppliers into that industry. And we chose to add to our exposures during that period, sort of September, October last year, because our valuation-based screening was suggesting that that was one of the most attractive parts of the market at that point in time, in terms of price relative to fundamentals and valuation, and that proved to be a sensible thing to have done, because since then we've seen a very strong recovery in a lot of those stocks, and that's contributed to good performance over the last 8 or 9 months. But we've seen similar periods, historically, where you've seen periods of underperformance of industrials, going back to 2018 and Trump putting tariffs on China. In that case, that was really a sort of blip where the market looked through that pretty quickly and those stocks recovered and our performance recovered with that. I think the more interesting one's probably around what's happened during the COVID period. So I guess the year after COVID, we saw an extraordinary period in markets where there was a lot of speculative investment in early stage technology companies. People were putting out indices of profitless tech companies that were outperforming everything else by a wide margin. And our focus on good quality, profitable businesses meant we didn't experience the benefit of that, and we underperformed the broader market. But the nonsense sort of valuations that were in the market in sort of late 2021, late 2020 and early 2021, inevitably unwound, and the fund performed very well on a relative basis as that happened. And I guess a lot of people sought exposure in things like solar and batteries at that point in time, but paid very high prices for businesses without strong fundamentals, and that led to underperformance. And we did relatively very well by having very limited exposure in those sorts of areas during that period. And then, more recently, I guess it's sort of more interesting contemporary example, 2022 ended up being a very difficult period for funds like ours when Russia invaded the Ukraine. A couple of things happened. Energy prices went up a lot, and interest rates, went up in response to inflationary pressures, and both those things sort of led to performance of sectors that a fund like ours just doesn't invest in. So financials did well, energy did well. I mean, alongside that, things like weapons and defence that we don't focus on perform well, and we had a period that was almost the perfect storm against our type of strategy. But what you find is most of those types of effects tend to be transitory, and the oil price went up a lot, and it's still relatively high compared to where it was before then. But over the long run, that's not likely to be sustained. Eventually, that's likely to come back down to more normal long run levels. And similarly, the outperformance of areas like financials was, somewhat temporary. Look, we've had our ups and downs, but what we try to do is maintain a very consistent focus on identifying stocks that can outperform, and there are always stocks that can outperform in the market and in our investment scope, and make sure that we're reducing our exposure in parts of the market that have become excessively expensive, and focusing on investing in areas where we think the return potential going forward is better. And if we can do a half decent job of that over time, we're quite confident that the tailwinds for the areas that we focus on, will mean that we end up with good outcomes for our clients in the long term.
And in regards to the types of investments, are there any recent examples you can talk us through where you've taken an opportunity and made something of it for the fund?
Look, in a 70 stock portfolio, there are always examples of, things where you've managed to take advantage of opportunities and it's worked well. And on the flip side, there's always examples in a 70 stock portfolio of things that haven't worked out as you'd hope hope they might when you bought them. A bit like the sailing analogy, if you can get 60% of your calls right in terms of what the wind's going to do in the next 10 minutes, you can be exceptionally good at sailing over a regatta of 15 races and 30 upwind legs. In our game, if we get 60% of our stock calls right, we'll be in the top decile of fund managers over time. It's very difficult because there are always a lot of unknowns and things that can change that can't be predicted. But look, I mean, if I look at a couple of things that have performed well, recently, Prismian is a stock that's performed well for the fund. I'm highlighting that as an example simply because it was up last night. As one of the better performers in the fund, but we've held the stock for probably 18 months now. It makes high voltage electrical cables used in grid interconnection, but particularly in subsea connections, which are used for things like offshore wind farms and grid interconnection between countries where you need to do it subsea. And that or demand for that product has increased very significantly with growth in renewable energy and escalating investment in grid interconnection associated with increasing renewable penetration. That they now have an order book that is going to keep them at full capacity, probably for the rest of the decade. If you want to build an offshore wind farm today, the gating factor for doing that is actually getting cable to connect it to the grid. It's not buying the wind turbines or anything else. And so over the last 18 months, you've seen the outlook for that business improve. Its margins are improving. Its growth profile has improved, and the stocks perform well as a result of that.
Fascinating, fascinating. How do you yourself and your team at Nanuk keep up to date with the changes in financial markets?
I mean, I guess in the first instance, we've got 6 of us trying to keep up to date with it, not just 1 or 2 of us. So there's a team of us doing that. We, I guess, have access to a lot of information through a variety of sources, and we have a set of tools for, I guess, filtering that information on a daily, weekly, monthly basis to focus on what is important for what we do. So obviously news flow in relation to the stocks that we're invested in, or news flow in relation to the industries that we focus on or are invested in at any point in time, but also a lot of sort of financial and fundamental and macro type data that helps us understand how things are evolving, not just in the areas we're focused on, but perhaps areas that we might not be invested in. And we have regular sort of reports that get run. We have regular meetings amongst our team. So we have a daily discussion with the investment team each day where we're discussing what is happening in relation to stocks we own and within markets. But then we have more formal reviews on weekly and monthly bases to I guess delve into the data in a bit more detail about what's driving performance of the portfolio and the individual stocks, and what's changing outside of our areas of immediate focus.
Okay,
but it's
and I've got
yeah,
sorry, I've got one more question for you today, and that is, what makes a good portfolio manager?
I think good portfolio managers need to have a couple of things. That at the heart of it is a very clear understanding of why it's possible for them to add value, to generate alpha through stock picking and running a portfolio, and how they're going to do that in a consistent way. So that's really the key to being able to deliver performance consistently, which is what what our portfolio managers are charged with doing. There isn't a right or wrong way of doing that. There are lots of different ways of capturing alpha within markets, and those different approaches can draw on different skill sets. But obviously, portfolio managers need to have a set of sort of analytical or qualitative skills that enable them to execute whatever their approach is well. And it doesn't mean that someone has to be IT savvy or extraordinarily numerate or very good at building Excel models. There are different ways of identifying opportunities and executing that, but people need to be good at what they are focused on. And then people need to be able to do it on a consistent and ongoing basis, and that can be challenging.
Definitely, definitely. Well, Tom, we've covered a lot of ground today. Is there anything else you'd like our listeners to know about yourself or Nanuk before we finish today?
Look, I think the interesting thing for our business over time has been waxing and waning investor sort of attitudes towards the kind of investment that we do. And when I say the kind of investment we do, focusing on a subset of broader markets defined by the sort of industries or particular technology groupings, which is not the way that a lot of investment managers narrow down their focus. Most investment managers tend to do it by focusing on higher growth stocks or value stocks or small cap stocks or maybe emerging market stocks. And those approaches have been executed well by a lot of people over many decades, and the traits that they bring are pretty well understood, and that the reason for including those kind of approaches in portfolios is well understood. This sort of more recent concept of thematic investment or industry focused investment doesn't have the same kind of popularity, and people have rightful concerns about including thematic funds within portfolios. But when you sort of step back and look at what those concerns are, it's the nature of what we do is actually not that dissimilar to more conventional strategies, and it has a very valid place within people's portfolios. So I guess the trends that we're trying to capitalize on have been underway for about 20 years now. And over that 20-year period, the quarter or so of the broader market that we focus on has progressively but quite significantly outperformed, and not just because valuations have gone up over that period of time. It's because the fundamentals of that part of the economy are improving in a way that other parts of the broader economy are not. And that trend is very likely to continue over coming decades. Unless unless someone disproves climate change and governments stop acting in order to reduce carbon emissions and reduce resource utilization, or if there's some wholesale geopolitical breakdown globally, and I think the probabilities of both those things happening are pretty low. Maybe the latter one's more reason for concern, but absent those kind of things happening, it's extremely likely that over time you're going to see a continuation of what's happened historically, and strategies like this over the last 20 years have actually delivered far more consistent outperformance than value or growth or small cap or EM or the more conventional sort of approaches that people pursue. And it's not something people should be concerned about having in a portfolio as being unusual or different. It's a perfectly logical thing for advisors to put in client portfolios and for clients to have in there. And of course there'll be periods like 2022 when it doesn't work as well as other strategies, but over time that the evidence is emerging that what we do is sound from an investment perspective.
Okay. Well, Tom, I appreciate you making the time to talk to us today. And if people need to reach out, where's the best place they can find you?
Well, I mean, you can go to our website, nanukasset.com, and contact details are there. We're always keen to engage with our clients and customers. And being an Australian-based manager, we're in a sort of advantaged position in being able to do that and provide not just the portfolio and investment returns, but perhaps some insights that might be useful to people beyond that.
Okay. And thanks again for your time, Tom. I really enjoyed the conversation and found it insightful.
Thanks, Joel.